Hare Krishna, welcome to my channel Purposeful Prosperity. We are continuing with our wisdom series from the Little Book of Common Sense Investing, and today we are continuing with our chapter 16, the index fund that promises to beat the market, the new shift which is happening. So let's just understand the main thing Bogle is talking about the factor investing and the smart beta investing. So what is the smart beta investing? So we have something called passive strategy and we have active strategy. So smart beta guys are trying to mix both the things together and trying to say that they are trying to give a low cost solution compared to active one, and they may perform better than the benchmark. They also promises to give diversification. So these are the things based on that people are nowadays becoming more interested on the smart beta or the factor based investing. Let's just see what is the Bogle's point of view on the smart beta investing. So first of all, Bogle is beginning with the statement that success breeds competition. We really understand that index is becoming more and more popular, and it's becoming a competitive field. Even the largest manager of the traditional index fund are engages in a competitive price wars. They are cutting their expense ratios to draw more and more assets from investors. So this definitely slashes the profit of index fund managers and discourage entrepreneurs who want to start new fund venture in the hope of enriching themselves by building fund empires. Yes, so that we really understand that index funds are becoming more popular. Now people are understanding the how the cost is going to impact in their investment journey. So definitely with the price war, everybody has to cut their expense ratio. We have seen that Vanguard is working on a 0.04% expense ratio, although in India it still ranges between 0.1% to 0.2%. But definitely this is going to come down as and when the assets are going to grow. So there is a famous quote by Mr. Andy Grove which says that success breeds complacency and complacency breeds failure. Only the paranoid survive. So what he is trying to say, so whenever we get some success, we actually our satisfaction, we lose our satisfaction. So whatever the self satisfaction that we are having, the success is making a break into that thing. And when you are not self satisfied, then whatever actions that you are going to take, that is going to lead us towards the failure. And only a few will survive when they are taking an action in a uh, unsatisfied way. So if a unsatisfied person is trying to make some decisions, then most of them are going to have failure, and only a few, which Mr. Andy call as paranoid, they are going to survive. So something similar is happening with these active fund managers also, with this smart beta investing also. Uh, where some of these funds have become really successful over the past, so because of which people are losing their satisfaction with the index fund, and they are trying to move from these passive indexing to the smart beta investing, and that is where they are going to occur these failures, and only a few paranoids are going to survive. So let's just see how these smart beta managers think. So first of all, they are advertising that they like to take advantage of these index funds. So how? So first of all, they create a new indexes and they join these ETF parades. So which is the exchange traded fund. So all these ETFs are being launched just to facilitate all these smart beta investors. So where they claim that these new index strategy will completely consistently outpace the broad market index. The ETF manager charges a high fees for that higher potential reward, whether or not it is ever actually desired. And then at the last, offering the promise of earning excessive return, the whole host of ETFs have sprung up to entice investor and speculator alikes. So that's something we really have to understand the thinking of these smart beta investor fund managers. If we don't understand that thing, we are going to make mistakes. So if you think that they can devise an index strategy that is always consistently going to beat the broad market index, do you think that why government is not going to use that index as a main index for our country? In fact, none of the countries are doing. All the countries are following this market capitalization based index fund. Why? If there is any data or any history which says that these smart beta fund managers can create some indexes that can consistently outpace, then why not our governments are implementing that thing? So that should be the question we should be asking. And I hope by now my viewers are intelligent enough to know that this is not something happening. So whatever is being told to us is completely lie. It's all about these advertising, and that's really enticing the retail investor like us. But we wise investor should not fall for those enticement. Next, Bogle discuss about these ETF and the active funds. Or these smart beta with the active fund manager. So active fund manager, we can say that they are known that only way to beat the market portfolio is that you need to depart from the market portfolio, and collectively we understand that they cannot succeed. Their trading merely shift ownership from one holder to another, and in this way only the financial intermediaries are the one that are really get benefited. They have a vested financial interest in making the case that if they have done well in the past, they will continue to do well in the future. And in case if they not done well in the past, they will there will be better days are ahead, always ahead. So these are the main principle on which active fund managers works. We need to really see that how many of them are really true. Then, if you talk about these ETF managers or the smart beta or these factor-based investment managers, they really sponsors of ETFs. On the other hand, they make no claims of pre-science. They most rely on one of these two strategy. So they offer a broad market index fund to the investor that can profitably trade in the real market, or they create indexes for a wide range of narrow market sectors that investor can swap back and forth and earning extra profits. So these are the main philosophies behind these ETF fund managers. So based on these two combination, people are trying to create some smart beta. So if we have to be really understanding the philosophy behind each of these managers in order to fully understand the picture that what is happening in the market. So as per Bogle, so what's happening is that the responsibility of investment management and portfolio strategy is being shifted from active fund manager to active mutual fund investor. This crucial shift has broad implication for the main street investors. I confess of being skeptical that this change will serve investor well. So we can see that from the active fund managers, when they are not able to beat the market, we see that a lot of ETFs are getting introduced. Once the ETFs are getting introduced, so many ETF fund managers coming, then these ETF fund managers created these smart indexes and factor based indexes, then to create those funds. So these active managers are converting their role from active managers to this active uh, mutual fund manager, and that's something we should be avoiding, because once again that is just a way to fetch the money from a common retail investor, and that's the beneficial for these fund managers but not for the investors like us. So let's just understand what are these passive indexers. So as per Bogle, these passive indexers are active strategists. So as per Bogle, they have largely chosen the ETF structure to market their products, and because it's a very easy market to enter. And then smart beta managers created their own indexes, not in fact indexes in traditional sense, but active strategy claiming to be index. So that's something we should be very careful. So many of these smart fund managers are creating their own indexes, but we have to really understand that those indexes are not well diversified compared to a traditional index fund. So although they claim this to be an index, but it is not actually an index. And these passive indexes, they focus on weighing portfolio by so-called factors like stock with similar, where they believe that is stock with similar forces driving their returns, rather than weighing portfolios holding by their market capitalization. They focus on single factors like value, momentum, size. They can also use a combination of factors such as corporate revenue, ROE, ROCE, cash flows, profits, and dividends. So all these are multiple factors, and I think each of the smart beta manager picks up his own favorite factors and he simply combines them and try to create an index out of that thing, which he assumes that it's going to beat the market. So we really need to think that is it smart to invest in these beta fund managers? So as per Bogle, as a concept, the smart beta is not a terrible idea, and but not this is not at the same time it is not a world-changing one. So a smart beta ETF manager rely on computers to parse heavily minded past data on stocks that will enable fund manager to identify factors that can easily peg the ETFs. So the goal here is to create a good profit for the manager by gathering the assets of investor seeking and performance edge. So we can clearly see that all this is being done just to make more profits for the managers, because more the assets they are going to get, based on that expense ratio they are going to get more money. And just on the name of smart beta, they can definitely charge more in their expense ratio, and that way they'll be having greater profits. So we really need to we can really see that smart beta fund managers are always looking into their rear mirror. They always say that looking at the past data, or they do this data mining, and based on that they say that okay, this is these are the combinations of factor which have always outperformed the market. But do we really agree that the past performance is going to be the future performance? I think we have already done a real discussion about this in our previous classes. Feel free to go back to few of them. You will have a clear understanding in case if you are new for this session. So we have seen that consistently outpacing the market is difficult, in part because of the power of reversion to the mean in mutual fund industry. So reversion to mean is a basic principle, and it's an arithmetic where Bogle is saying that it applies to all the mutual funds. And the same thing is going to be applied even for smart beta investing also. So today's winning factor are all too likely to be tomorrow's losing factor. So there can be some factors where you are believing that maybe from the data of past 15, 20 years, you may be the winner, but maybe you are going to have another 15, 20 years where you are going to be a loser. Then what are you going to do? So similarly, these although investing in the smart beta, you are going to become just like an active investor. And once again, these active investment cannot beat the index fund, a low cost index fund. So Bogle clearly gives a warning that investors who disregard the RTM or the reversion to mean are all too likely making a huge mistake. So this principle of arithmetic reversion to mean is very important. If any of the retail investor we are ignoring them, then we are making a huge mistake. And we should not make this mistake in our investment journey if we really want to create some good wealth for ourselves. So as per Bogle, the successful short-term marketing strategy are rarely, if ever, optimal long-term investment strategy. So all these smart beta and factor-based investing, they are short-term marketing strategy. They cannot be your long term investment strategy. So, if you are still excited about all these things, then feel free to create a satellite or a small portfolio and see the performance over a long run. But your core portfolio should be still sticking with a low cost index fund. So, we have really seen that past performance does not guarantee the future return. But as for Bogle, this will not surprise you that the fundamental factors that ETF entrepreneurs typically identify are the basis of their portfolio strategy have actually outpaced the traditional indexes in the past. But in investing, the past is rarely prolonged to the future. That's something we have to really understand. That all these ETF managers can show you some data, and through which they can say that they are consistently beating these traditional index fund. But then this is all about the past, and past is not a guarantee of future results. That's something we have to understand. We cannot drive our investment journey by looking at the past mirror. So here is Bogle is trying to give us small data, because these smart beta funds are pretty new. So not much of the data available. Even Bogle is trying to give just a 10-year period, which is a short period of time, and where he's trying to compare three funds. Two of the smart beta funds, one is using fundamental factors, other is using dividend based factors. So we can, if you look at the annual returns, they are pretty close. So although the fundamental base uh, smart beta has given a higher return, but it has taken a higher risk also. So if you look at the risk adjusted return, which is the Sharpe ratio, if you look at this, then the Sharpe ratio of the index fund it's better compared to this fundamental and the dividend one. So over the long run, there may be a chances that all of them are going to perform similar, because we can see that definitely they have a strong correlations. We have 0.97% relationship, but definitely we have to understand that S&P 500 has performed well, but we don't know what is the future of these uh, 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 smart beta investing factors. So that's something we are not sure. We have seen the past, but we have not seen the future. So that's why the Bogle is simply asking that you must ask yourself these questions. Among similar portfolio, do I prefer a certain outcome or an uncertain one? Is it better to be safe than sorry? Then Bogle is leaving that choice to us. So we have really seen that we have certainty that low cost index fund based on their market capitalization is going to perform good. But nowadays there are many indexes, smart beta indexes, where the same set of stocks are there but with uh, different proportions. So we have to really understand that we want to be on a safe side instead of then on a sorry. So definitely, once again, your core portfolio should stick to a low cost index fund only, and not to the smart beta or factor based index investing. So as per Bogle, many of these smart beta fund managers are in fact, the active fund managers. He is simply assuming that he's simply marking them as an active fund manager. But they not only claim pre-science, but a pre-science that gives them confidence that certain sectors of the market will outperform the broad index as far ahead as the eyes can see. So they have this pre-science based on this data mining, based on whatever factors they have selected, they have backtested in the past. And that is giving them the confidence that these factors are going to outperform in future also. And that is where they are making a mistake. And we should be avoiding all these mistakes if we really become wiseful investor. So Bogle clearly says at the end of the chapter that I urge you not to be tempted by the serene song of paragrams that promises the accumulation of wealth that are far beyond the rewards of the traditional index fund. So he clearly says that don't go for any of these temptation where they are guaranteed to give a far better return than traditional index fund. Don't divert your mind to these advertisement which all these mutual fund companies are going to put on a daily basis to all of us. We can really do a more damage to our fund by just getting more of these advertisement. So try to avoid all these things. Listen to the wisdom of Mr. Bogle, Mr. Warren Buffett, and many other great investors. Then Bogle is giving a very nice quote where he says that the greatest enemy of a good plan is the dream of a perfect plan. So stick to a good plan, which is the traditional plan. So definitely we all want to select a mutual fund combination or a mutual fund portfolio that is going to perform the best. We want to make our portfolio perfect. But in order to make that perfect, we are going to make many of these mistakes if we are not selecting the good plan, which is the traditional low cost index fund or the passive investing. If we are simply ignoring that thing, then we are the greatest enemy of our own investment journey, and we should be avoiding that mistake by sticking to a traditional low cost index fund. So Bogle gives the warning. He says that put your dreaming away, pull out your common sense, and stick to a good plan, represented by a traditional index fund. So Bogle's conclusion is pretty clear that we have to stop this dreaming or trying to beat the market. We have to use our common sense and then stick with a traditional index fund. Uh, Then there is Mr. Mankins, and another Harvard professor. He also saying something similar with the Bogle, where he says that speaking about the competition between traditional index fund and the smart beta, I am placing my bets with Bogle on this one. So this Harvard professor is definitely saying index fund is his preferred choice compared to the smart beta funds. We have Mr. William Sharpe, who is the professor of finance at Stanford University and also a Nobel laureate in economics. What is his views? He simply says in a one line that smart beta is stupid. I know many of the viewers who are trying to have these smart beta funds in their thing, they might be feeling offended, but that's the truth. A Nobel laureate in economics is saying this thing. So you cannot ignore such statement. He further says it is quite remarkable that people think that somehow a scheme that weighing in stocks differently than capitalization can dominate a capitalization weighted index. So he's saying that this is a surprise to him how people can think like this. So as for him, new paradigms comes and go, and betting against the market and spending a considerable amount of money to do that is indeed likely to be a hazardous undertaking. Yes, we all try to divert from this market capitalization based weighting index, trying to go for the smart beta indexing, and we are paying extra expense ratio for those things. And if we are doing that mistake, then as per Mr. William, we are also the stupid, just like the smart beta indexer. So, guys, don't try to be stupid. Try to become a wiseful retail investor in your investment journey and become successful in getting your financial goal completed. There is another famous book, uh, uh, Stock for the Long Run, where Mr. Jerry has put some nice comment about the similar thing. And he says that it can be shown that maximum diversification is achieved by holding each stock in proportion to its value to the entire market. So diversification is the key. Yes. So definitely for diversification, the best way to achieve diversification is sticking with a market cap weighted uh, low cost equity index fund. He further gives a warning that most of us trying to beat the market leads to disastrous result. Yes. And unfortunately, we all real investor trying to do that mistake. And all these great investors are trying to say not to do this thing. Our actions leads to much lower return that can be achieved by just staying in the market and matching the market year after year with the index fund. So he is also giving his summary that we should be sticking with a low cost index fund only and not trying to beat the market, just getting the return of what our stock market is giving. If we get the fair share of return, that itself is going to create enormous wealth for all of us that we can't even imagine. But we are, instead of doing that thing, we always try to be put in the race to beat that market, and that's where we are making huge losses, and we are really hampering our investment journey and not able to even fulfill our financial goals. So I hope with this chapter, I think by now you guys, all of you guys, have an answer what's need to be done with the smart beta or factor investing or those new indexes which have been created nowadays and which promises to beat the market. So I think Bogle's advice, Mr. Williams' advice, all their advices are pretty clear that stick with a low cost market index fund, which is based on the market capitalization. But In case if you still don't agree with those arguments, then I will highly advise, please don't make that mistake for your code portfolio. Create a small satellite portfolio, and there you can play around with these things. But never make a mistake to make these kind of include those uh, smart beta indexes or factor based funds into your code portfolio. Otherwise, you are really going to hamper your investment journey. So thank you for staying with me. I hope you guys make something out of this thing. I think this was really a nice chapter because many of these smart beta and factors investing has been introduced recently, especially in the Indian market. Uh, so I hope you now my retail investors are able to make a wise decision based on whatever knowledge we have gained from Mr. Bogle. So if you think that this kind of videos are really helping a retail investor, a common retail investor, then feel free to like, share, and subscribe and make sure that this kind of a video reaches to most of these retail investors so that they can avoid those mistakes in their investment journey and always stick with a low cost index fund and get their financial freedom. So I'll definitely going to continue. I think we left with only 4 chapters. We are going to finish this book soon. So very soon I'll be coming with the next chapter. So till then, thank you very once again and Hare Krishna.